GM, good morning. Welcome to the Milk Road Show, the daily crypto show that's spicier than your favorite hot sauce on Taco Tuesday. I'm your host, Jay Hamilton, and today we are joined by Capital Flows. If you guys don't know who Capital Flows is, you are going to be so fired up for this episode. Not only is he a true expert in macro, he also produces incredible content around basically every major macro event that happens. And the best thing is he does an incredible job at explaining why you must understand macro if you are an investor. If you're an investor and you're not paying attention to macro, you, as he would say, are making a massive mistake. And that's what today's episode is all about. We're also going to cover what happened in the Fed meeting this week, the rate cut, the outlook that Jerome Powell shared, and what does that mean as we go into 2025. Now, before we jump in, as we talk about 2025, I'm super excited for the next 2 weeks. We have lined up a whole bunch of episodes for you guys where we are going to look forward to 2025. We brought in our favorite experts from the last year and asked them all what their predictions were. And the best part is they all have different predictions. So it's really going to help you guys understand how you want to position your portfolio for the next year. Before we jump in and hear from Capital Flows, we need to take a moment to hear from our sponsors who make this show possible. Meanwhile is the world's first licensed and regulated life insurance company built for the Bitcoin economy. They do everything in BTC. You pay in BTC, they pay claims to your family in BTC. You take out policy loans entirely in BTC when you need liquidity. Protect your family from life's uncertainty and a broken financial system. Build intergenerational Bitcoin wealth while the cost of living skyrockets in dollar terms. Plus, get all the tax and legal benefits of life insurance now in Bitcoin. Visit milkroad.com/meanwhile to join the waitlist and get early access to the world's first Bitcoin life insurance. Whether you're bullish or bearish on MicroStrategy, T-Rex ETFs are your gateway to dynamic market plays. Get exclusive access to leveraged exposures with the first 2x short or 2x long ETFs designed specifically for MicroStrategy stock. Position yourself with precision. With T-Rex, you gain access to powerful tools for sophisticated investors. Capital Flows, welcome to the Milk Road Show.
Hey, thanks for having me. I'm excited to chat with you today.
Likewise. Okay, I got to start with, I'm going to pull up on screen here a quote from a article that you wrote on December 7th. And in this, you said, when we look back at 2024, it is very clear that Wall Street has such a low quality understanding of how macro flows function and why assets move the way they do. Why did you write this? Why does Wall Street have such a bad understanding of this?
Yeah, well, when we kind of came into this year, we had a lot of interesting things set up where a lot of people, had these ideas that there was going to be a recession, that there was going to be all of these, changes where the interest rate hikes by the Fed were going to, cause this, really big collapse in growth, a lot of things along those lines. And, something that I've been laying out consistently is that when you have growth that's positive and then you move into a cutting cycle, that begins to push asset markets up, right? Because you're having, overall growth in the economy remain positive, which just feeds into the support of risk assets. And then you have the Fed cutting, which pushes liquidity into the market and across the risk curve. And so when we look back now, you basically see every single major consensus indicator, expectation by economists, every single major metric just show that everything that, all the major economic events that people expected at the beginning of the year basically got crushed. And that's part of the reason why we saw such a large rally in basically all risk assets, from the equities to, broad crypto and Bitcoin and everything else. And that's one of the reasons why we saw such a large rally, is because consensus expectations just got caught so far offside given the macro regime.
So I have such a hard time. I mean, you've been operating in this space for a lot longer than I have, and a lot longer than our listeners have. Why is it that so many of these experts are not looking at macro or not seeing it this way? Are they just I just can't wrap my head around. It seems so obvious to me when I hear somebody put it the way you did. Is there like a broken system here? Is it like, what is the cause?
Well, I think there's two major causes in the way that I, look at the industry. Number one is you have, this conflict of interest, right? Where you have all of these people working for institutions or banks or whatever it might be, and at the end of the day, they're talking a book, right? I mean, people don't go into this as much, but there is a correlation between, the research that you have, and then sometimes when, banks are moving around their balance sheets or their books or something like that, just to be able to get exit liquidity on things. And so that's one aspect of it. And then the other aspect is that we're moving into this, just period of time on a bigger picture basis where you have the financial economy and, financial markets interacting with this attention economy, right? Like this whole idea of like new, like social media use since COVID has gone through the roof. All of these different things have increased exponentially. And at the end of the day, fear sells, right? Like that's why people recognize that, hey, if I'm just bearish, regardless of what happens, or if I can figure out a really good clickbait headline, I can get people to listen to me. And that works maybe for some, like, a short term following or something like that. But at the end of the day, the question is how much of a, quality is being brought behind that headline to support just, that thesis with some rigor. So I view it as those two big things for why we kind of have that situation that we've had.
Very interesting. Yeah. And it's so true and so obvious. So what I want to do today is I want to make sure our audience can see things clearly and not get caught in that the wrong attention or the wrong clickbait, but also can see really what does drive markets, what does drive assets, because you have such an ability to point this out in such a simple way. And so I'm just going to share a slide here. And for those listening, we will explain it. In your view, what drives assets? How do they move?
Yeah. So I like to, come to every single asset, and it's just kind of like the, basic, middle school question of like ask the questions: how, why, what, where, when, all of those, why questions, the W questions. And the most important thing you can do when you come to any asset is not just see that it moves and the direction it moves, but why it moves. And so the way that you do that is you come into the asset and you say, what are all the underlying drivers that occur? Maybe they occur at different times, but what are all the main drivers that push this asset around? And when we go through every major asset, including the S&P 500, Bitcoin, Ethereum, Solana, any meme coin or underlying, smaller crypto asset or whatever it might be, when we look at those, the majority of the price moves in all of those assets are connected to macro drivers. And there's a reason for that because, macro is about what are all the main drivers that are occurring in terms of growth, inflation, liquidity. And, when you think about all these assets, what are they priced in? Bitcoin is priced in dollars, right? Like every single asset is priced in dollars. So the value of those dollars is a critical input into the movement of the asset, right? And so everything is in a sense a pair trade, right? Where we know that you have kind of Euro USD, where you have the euro and then you have the dollar, and those move depending on where those two currencies move. The same thing is really true for an asset like Bitcoin and the S&P 500. You're just saying what is the value of the S&P or Bitcoin against dollars, and if you have some dollar devaluation or whatever it might be, or if you have strengthening in the dollar, like 2022, where the dollar increased in value, then that is going to revalue all these other assets. And so to kind of pull things together, when we look at every single major underlying driver for why an asset is moving, it always comes back to macro drivers for the majority of those moves. Now, there's going to be sector moves, and that's why this visual on the screen kind of shows that. 80% of the moves are typically attributed to macro. And then you have other moves.
That's incredible. I just got to pause for a second because
Yeah.
if this is the only thing that our listeners take from this episode, it's this number right here in my mind. That 80% in your view, and I would agree with this, and I know our team would agree with this as well, that assets are driven 80% by macro factors. 80%, everybody. So just think about that for a second. Like if you are missing, if you're not understanding what's going on in macro, and we'll explain what drives macro in a second, but if you're not seeing that, you're missing 80%. And I think a lot of people are missing this.
Yeah, I mean, I agree. I mean, there's definitely there's a lot of papers and there's a lot of ways that we can prove that 80%, right? That's not just kind of a narrative we throw
Mhm.
out. There's statistical evidence when we look at just the breakdown of, the attribution analysis for returns that the majority of the drivers are macro. And so it's just critical because if you can get, I think this is an interesting thing that clicked for me like in a long time ago, whereas you can get the fundamental view right on a company, but if you get the macro wrong, then sometimes it just doesn't matter, right? You
Mhm.
can you can get the perfect stock or coin or idea or expression, but then if you have macro come in and change, it'll sideswipe your view, whatever that might be. And so it's just, I mean, part of it is just saying, what is the macro regime I'm in? Let me just get the context right. And then how does that tell me to do, to frame the certain actions that I take so that I can, make sure that, I have, kind of the tailwinds of my sail.
Yeah, completely. And so 80% driven by macro. The other two drivers that you have here are 12% driven by sector and 8%, only 8% driven by fundamentals, which is probably, if you looked at the way people think, it probably inverses this. They probably think mostly about fundamentals, second, maybe actually mostly sector, then fundamentals, and then macro. Too many people are in that boat. I want to touch quickly before we get to really the meat and potatoes of this episode, which is exactly what you said: is if you're missing the macro regime, if you don't understand the current macro regime, then everything else can get sideswiped in your investments. And so we're going to talk about exactly what came out with the Fed meeting this week and what that means and what is the current macro regime. But before we do, I just need to also touch on, because you just, again, I love your way of putting this. This is like a kindergarten grade 4 class: simplify, simplify, simplify. And this helps so much for everybody and our listeners here. So just quickly, what are the macro drivers? If 80% of the market is driven by macro, what drives macro?
Yeah. So when we break down macro, it really comes down to growth, inflation, and liquidity. And, I'll explain what those are. But, at the end of the day, we live in a nominal and a real world, right? You and I, and, every single company around us and in our neighborhood, they have changes in the quantity of goods or services they sell, right? The number of people that come in and buy a cup of coffee, the number of people that go to the lot and buy a car, right? There's always going to be a certain quantity of goods or services sold. And the growth part of macro just says, okay, what's that quantity? What's the real, number of the quantity of goods and services sold? And then, we take that number and then we compare it with inflation that says, okay, we have this number of, actual stuff that's being sold. What's the price that people are paying for it? And how is the nominal world of money and the amount of money in the economy and in the financial system, how is that interacting with the quantity of goods or services being sold? And so, growth is about, okay, how much stuff? Inflation is about what's the price for that stuff? And then when we, think about liquidity, liquidity is really a facilitator for a lot of those purchases. So, liquidity, if we're just thinking broadly, one of the main drivers of it is the Federal Reserve because they are setting the price of money. Interest rates reflect how much you have to pay for a mortgage, right? It's how much you have to pay to use the bank's money to get a mortgage or a house or any type of durable good. If you're buying a jet ski or you're gonna go do something fun, right? Like that's the price that you pay to use someone else's money to borrow it, which means that the price of money and interest rates is directly connected to your ability to buy and sell things, right? And so when you have growth, which is the stuff that you buy, the quantity of stuff, you have inflation, which is kind of talking about the price of those, and then you have liquidity, which is what allows money to be used for those. you basically have growth, inflation, and liquidity working together, and they work in, sometimes reflexive feedback loops to push the entire macro regime forward and really drive all asset markets and every kind of single major thing in the economy and markets.
Unbelievable explanation. Just you put it so simply, which is so nice. I want to go to what happened on Wednesday in the Fed meeting. So, because that's a perfect transition from if macro moves markets and the current macro regime, and we're talking about growth, inflation, liquidity. And you mentioned yourself that the Fed controls so much of this. So, what happened on Wednesday this week, and what does that mean for the current macro regime?
Yeah, so on Wednesday this week, so yesterday, we had the FOMC meeting. And, we have these meetings where the Fed decides if they're going to increase or decrease interest rates, right? The discount rate, which is the base risk-free rate for all money in the system. If you kind of think about the Fed and that interest rate that they're moving, that's kind of like the asymmetrical linchpin on which the door of the economy turns. So if you get that interest rate right, you know how that reverberates across every other interest rate in the economy, every other debt instrument. If that interest rate moves up, it makes financing more expensive, which means less people might buy houses, they might buy less cars because they can't get that debt to be able to purchase that. So we have these meetings every month or so, depending on the timing. But when we think about where we've been overall, we came into the year where there was a question of when is the Fed going to start cutting? And they started cutting in September of this year. Now, when we look back, especially, retrospectively, we know that the Fed came in and they started cutting rates in September. The problem was they started cutting with a 50 basis point cut. Now, if you look historically, the Fed typically cuts 25 basis points or maybe hikes 25 basis points here and there to moderate their actions. The action of the Fed cutting 50 basis points is something they typically do when things are falling apart. And so when the Fed started the cutting cycle, they did it in a way that was likely unwise. And what a lot of people look at retrospectively now is a mistake to start so aggressively. And that's one of the reasons why it got everyone expecting that there's going to even be more 50 basis point cuts or something like that. As a result, we've seen this repricing in rates where they've moved higher since September because of that mistake by the Fed. Now, since that time, the Fed has done a couple more rate cuts. And the meeting that we had yesterday, the Fed came out and also did a rate cut. But the thing that the Fed really shifted was that when they talked about 2025 and they said, okay, what are we going to do in 2025? How do we view the changes in growth, inflation, and liquidity? How do we think about those? The Fed said that they basically have an expectation that inflation is going to rise marginally in 2025, which in the models that I run and that we really kind of map all of these different moving parts out, unlikely in our view right now. And so when we think about how the Fed came in, they came in a very hawkish way. And they basically said, hey, we think that we're going to, pause or maybe not even do that many cuts in 2025 because we think that, we need to push down inflation a little bit more, even though inflation is, much lower, compared to, where it was earlier this year. So if we kind of think about the main idea to take away from yesterday's meeting, it's that the Fed is going to try to put more downward pressure on inflation, even if that means you have some weakening in growth. So, we had growth be, fairly positive, incredibly positive in 2023. Came into this year, it was still positive, but it was lower, right? You had 5% real growth in 2023. Now this year, we're kind of fluctuating between this 2 to 3% range. So you kind of have to be a little bit more careful, right? If, how many cuts are you going to do? How fast are you going to do them? So you got to be a little bit more careful with rates. Now the Fed, we're at this lower level of growth. The unemployment rate has ticked up a little bit. Now the Fed is coming out and actually being a little bit more hawkish at a time that is probably not optimal to be very hawkish. And so that's why you actually saw risk assets sell off. You saw the S&P down over 3% on the day. You saw Bitcoin down on the day. You saw, all of these different changes. You saw the dollar rally and you saw bonds sell off. Yesterday was actually a little bit of a 2022 illusion and a little bit of a, calling back to where you had stocks down, bonds down in 2022. So that really sets up for how we're going to move into 2025 and how to think about that new year that we're moving into.
Yeah, great. So we've been talking a lot about 2025 as having this incredible bullish setup that
Hmm.
liquidity is looking really good. Growth you mentioned has been it was looking good and then it wasn't looking good. It's kind of been flipping back and forth. Inflation sort of also has been on the downtrend, which feels like, hey, that's also a positive. What's your outlook for 2025? Are we in this, Goldilocks dream case scenario, or is there a little bit of concern here?
Yeah, so I think about 2025 and where we're at just with the structure of the economy in two ways. Number one is the consumer balance sheet is not over leveraged in the same way that it was in the, pre the great financial crisis or something like that, right? So even if you did have a little bit of a tick down in growth or maybe a growth scare, it's going to be really difficult for that to materialize into a prolonged deleveraging event, right? That's why, betting on a 2008, redo is really tough here because we just don't have the same asset liability mismatch, right? So when we think about 2025 as a whole, we are likely to have growth scares and inflation surprises that don't materialize into a change in regime. So that's how, really, I'm thinking about it where, you kind of had inflation probably tick up here or there, but we're unlikely to move into like this 1970s, cycle where inflation just goes right back up to, all-time highs again. Unlikely, just kind of given the Fed stance, right? So maybe have a surprise in inflation, but not materialize into an inflation cycle. And then on the other side, we're likely to have, maybe some type of growth scare, especially with the way that the Fed just acted, right? Because when you raise rates when growth is at this level, it can put some more downward pressure on growth where you have a bit of a growth scare, kind of like August earlier this year, where you had the unemployment rate tick up, Bitcoin equities sold off, bonds bid, and you had a little bit of an unwind, but then it couldn't really have durability just because the underlying economy remains resilient overall, right? So, when we think about 2025 and, all the data sets that we aggregate and we really use to kind of model out those different scenario analysis, you know, it really looks that we could have some risks on either side, but they're unlikely to materialize into this structural regime change like we had like inflation in 2022 or like a recession in 2008.
Fantastic. Love it. That's great. It's great to hear. Thank you for confirming that for us and for reminding us all that like these scares will happen. And this is why it's so tough because, and you said yourself, we're in this attention economy. Everywhere you look, you get different viewpoints and somebody's saying a recession is right around the corner or it's going to be 2008 all over again. Oh my gosh, fear, fear, fear. And you start to say, oh shit, like, should I be worried about that? And so it's very difficult to know who's right and who's wrong, which is, I hope, why everybody listens to this show on a regular basis, because we do our best. We're not always going to be right, but we do our best to bring on varying opinions and varying views to help you guys make the best decisions. So let's just talk about liquidity for a minute. That's another, obviously, a key driver of macro. I think from a lot of people that we talk to on the show, they would say the most significant driver of macro. I don't know if you feel that way, but where are we at in liquidity cycle? Is liquidity ticking up? What are we seeing from different governments around the world in terms of printing?
Yeah, great question. So I think in terms of liquidity, there's a couple different kind of subcomponents or buckets when I think about liquidity. One is just what is the Fed doing with interest rates? Number two is what is the Fed and the Treasury doing with the quantity of money in the system, right? Because the Fed can, let's say they can do QE or QT where they buy securities. You kind of remember in COVID when they just went out into the market and bought corporate bonds, right? Stuff like that. And then the third one is just cross-border flows, which is how are foreigners, coming into the market and adding liquidity because they want to buy the US, right? So those are, I would say the three major buckets that we're thinking about. And when we kind of look at that broadly, we're continuing to see foreigners put more money into dollar denominated assets, mainly because, the US is the reserve currency of the world, right? When you have that take place, foreign, countries and investors and everyone wants to own dollars because it's the world reserve currency. We just see that reflected in the data, the sentiment, the cross-border flows, just everything. And that's really not changing. That's actually, the fact that the dollar is the reserve currency for the world is actually the most bullish thing you can have for crypto, right? I mean, if you actually had the dollar lose its reserve currency status, you would actually begin to have more bifurcation in the world because you wouldn't have this global central hub where everyone can come and get liquidity, and you would actually have a decrease in liquidity in the world, at the very least for a couple years, as this new financial systems kind of normalize. That's not really something on the time horizon and kind of on the horizon that we're looking for, but the fact that the US dollar is the reserve currency status is very bullish for liquidity overall. So, cross-border flows, for investors, positive right now. The quantity of money in the system is, I would say, functionally neutral right now. The Fed is not really increasing or decreasing. We have some other kind of, things to look at, but, pretty neutral right now. And then in terms of interest rates, the 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 actions of the Fed more recently have put a little bit of a negative liquidity into the system with interest rates. But once they realize that, that's a bit of a mistake and they need to kind of reverse that, that's going to, create more positive liquidity in the system as interest rates are likely to come down in 2025. So those are the three buckets that I think about. And on net, I would say, skewed to the upside, liquidity just overall in 2025, but you're going to have these, short-term moves against the liquidity regime like we're having right now with these interest rate moves that are likely going to be opportunities to buy risk assets or things like that.
Okay, so expect some pullbacks is what you're saying there.
Absolutely. Yeah.
Do you have a view on that we might see a pullback in January? There's been a lot of guests on the show recently who have said that they think that could happen, especially with a lot of people circling January 20th, Trump's inauguration on the calendar. Any thoughts on what we could expect to see in January?
Yeah, so there's kind of two main reasons why people think that you're going to have some pullback in January. Number one is just seasonality, where if you're up, over 20% year to date, which we are in the S&P, and you move into a new year, there's just a lot of indiscriminate buying and selling that takes place because you're sitting on so many gains, especially from a tax perspective or a positioning perspective, and you have some changes on a marginal basis. So that's number one. Number two is the fact that the Fed is likely to pause in January, right? And so that's already priced in the forward curve. That's already an expectation. And so those are the two main reasons why people believe that there could be a bit of a pullback just mechanically in January. Now, is that an opportunity to like short the market or anything like that? That's not something that I would immediately go to. It's more of like a risk to hedge, mainly because we're not seeing enough underlying deterioration in the economy to justify this flip where we would go short or get really bearish or something like that. So is it possible? Yes. There is the possibility of that. I would view that more as if that took place, I would view it as a buying opportunity. And, probably not something I would try to time to get short, just given the underlying macro regime.
And if you're not buying, not looking to sell, if you're already allocated, just don't panic situation, basically. And it sounds like you're saying that could happen a few times through 2025 is expect that these pullbacks might happen, but it's not the end of the bull cycle. It's just a regular market cycle.
Oh, for sure. I mean, I think if you just look at the last, couple years in the S&P 500, look at, other years where we're not in a bear market like 2022, just think about how many pullbacks are in the S&P, right? Yeah, let's just say you have five, just like give or take. okay, so you have 5 pullbacks in the S&P, give or take. That's going to probably translate to, more or less, a similar amount or more pullbacks or rallies in an asset like Bitcoin or some other underlying sectors or stocks. So, on net, when I think about an asset that has a higher volatility than the S&P, I expect it, if it's going to outperform, I also expect it to have larger dips, right? So, it's the whole idea of, if you want to, sit for the 100% gains in Bitcoin, you also have to sit for the 20% drawdown, right? You can't just have one without the other. So, I think about it in that sense. Until we see a durable shift in the macro regime, it's not really a situation where I would begin, pulling, more money out of risk assets on a cyclical or structural basis. So for now, I would just, be looking for those, expect them, kind of prepare mentally for them, and just continue to watch the macro regime to see if it does shift. Then I would change my actions. But for now, it's not at that place.
Let's just talk briefly about that before we wrap up here. Is what two questions? Any idea of like when do you have any timelines on when you think the macro regime might shift, or when might be the peak of this bull run? Is it early 2025 or is it more like later 2025? I know you don't have a crystal ball and you can't predict exactly, but any idea on timing? And then what would you be looking at, or what will you be looking at in order to tell you what indicators matter most to tell you that is happening and coming?
Yeah, so I would say on the timing question, when I think about markets, I'm always looking at what are the signals that I need to know for, a certain event to take place. Because at the end of the day, if you're projecting out like a certain time horizon, like, oh, I think this is going to take place, like overall, I don't, I haven't seen a huge amount of predictability for that. I've read a lot of like studies on that and saying, how can we project forward with these different things? At the end of the day, you're always looking at, what are the signals that you're receiving that tell you to take action. I always think about it as kind of like it's just like, in a relationship, right? You get some signals and you take some action, right? And you see what happens, right? It's not complicated. So
You're
when I
saying
think
we
of
should get my wife on the show and talk
where is
about
she, man? Where is she?
yeah, yeah, we
She's gonna
can
have better
break that
advice than
down.
I do. So yeah, when I think about 2025, or let's say recession risk, or when are we going to have a recession, right? That's an important question to ask, right? There's going to be a couple things that you want to look for. So number one, it's going to be what we call, a correlation in data. So what we see is not just one data print coming in, indicating some slowing growth, like the labor market, like ticking up here or there. What we want to see is a correlation across data where we have pervasiveness in growth contracting. So we see the labor market softening a bit. We see credit spreads rising a bit. We see, just consumption and investment in the economy just slowing marginally. And we begin to move to that 1% level in real GDP, with maybe the interest rate side of things lagging a little bit, and it's not being, accommodative enough, right? So there's a couple different things we want to look at. We want to see just deterioration in broad economic data, not just with one data point, but with multiple, with kind of, across everything. And then we want to see a marginal pricing in the market of that risk, right? So right now, credit spreads, which are reflecting credit risk in the overall economy, are incredibly low. Basically, the market is saying credit risk in the economy is low. We just want to see that change on a marginal basis, right? And that shift where you're pricing a marginal probability of, growth contracting and things like that. Then from there, we can say, okay, does this have durability and how long is this going to go on for? So I would really, come at it like that. And that's, in my view, that's why it's so important to not just take a single data print or a single data set, but basically aggregate every single economic data point in the economy, in the US economy and every other economy, and pull them all together, synthesize them properly so that we can say, what are the tension and balance of risks, instead of kind of, if we think about what we talked about at the beginning of the show, where those economists, are just wrong on all of these expectations, it's because they're taking a single data point and extrapolating it to the entire system, right? And we know not to do that, but people still do it, right? It's kind of with their relationship analogy. If you take one thing and you're just like, hey, you always do this, right? It's just like, well, that's not a recipe for success, So, I think just taking all of those data points together and looking at that to just take actions incrementally.
So when you bring up the question, and it's hilarious that you keep driving us towards relationships. I feel like I need to tell Sam, my wife, to listen to this show, and then we'll have a conversation. We'll record it and send it to you, but not to anybody else.
Done.
You asked the question, and I think I also agree. This is a very important question to ask: is when will we have a recession? But also, kind of the question to me is like, can we have a recession? Like in this current macro regime, and we've talked a little bit about in a past show with Tyler Neville, who I know you know well, about this. And can we even have a recession right now? It sort of feels like we can't. What are your thoughts on that?
Yeah, so I think, and I think Tyler and I have talked about this a little bit offline, but 'cause I'd be curious what the view that he shared. But overall, since 2020, we have shifted in the regime that we're in, right? Where we're in a different macro regime, different compared to like the 2010s, right? 2010s, kind of, low, stable growth, inflation was low, interest rates are just kind of trending to the downside, risk assets rallying here and there. Maybe we have a couple risks here or there, things blow out, but, overall things are fine. In 2020, we had this shift where when you add a couple $1 trillion to the system, you get this step up in basis. It's not necessarily a good thing, but it creates a scenario where inflation risk becomes a higher probability than growth risk, right? On just a structural basis. So, this is something I've been talking about over the, just since 2021, 2022, 2023, where, I say, if we just look forward with the amount of money in the system, with the amount of, things that we're doing with onshoring and all these other things, if we just look at and think, conceptually over the next decade, do you think we're going to have more spikes in inflation or more, growth scares? And for me, when I, think about where we're at with just the structure of the economy, it's likely more inflation spikes and more inflation risks. Now, maybe that's not, a 1970s 2.0, right? I wouldn't use that exact parallel because we've actually had some changes in the CPI basket and a lot of these other things that are, that will create some discontinuity between that. But overall, it's the inflation risk that is a higher kind of probability just in the structure of the economy over the next 5-10 years. Until we really, kill that and really get inflation back down to like maybe deflation or something like that, until that happens, it is more difficult to get a recession, right? But that doesn't mean that you can't have this pullback in risk assets. That doesn't mean you can't have a bear market, right? Because if you think about 2022, that happened because of inflation, not growth. So I just think it's about, understanding the risks on either side of the cliff and understanding how assets can move in either scenario.
Mm-hmm. Yeah, wonderful. So well explained. Capital Flows, this has been a very insightful and educational episode. Thank you so much for joining us. Everybody listening in, I'm curious, how do you guys feel about your macro knowledge, your understanding of growth, inflation, and liquidity? Do you want us to cover these things more? Let us know in the comments, and let us know if, for me, a very bullish setup still remains for 2025. Although with the caveat, as you said, that we will have some scares, and some of those scares are probably going to be blown out of proportion when it comes to attention and media. So keep your eye open and don't panic. Stay calm through it all, because psychology is really more than half of investing in the end. Thanks again for joining us, Capital Flows. Everybody have a wicked awesome day. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your number one resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.